Okay,
Perfect.
good. Okay, good evening, folks. Welcome to the first webinar of 2026. On behalf of Matt and myself, and Donna is upstairs doing the coordinating. Happy New Year to all, and trust everyone had a good holiday. So we're going to tag team tonight, Matt and I, back and forth here a little bit. It's going to be one of the more informal webinars of the year because it's just Matt and I. And I hope people will won't be shy for asking questions or contributing tonight. It makes it a little more interesting for all of us, and it's not quite the banter I'm used to presenting live, but we're going to do our best here tonight to keep it moving along. So a few housekeeping things to start. Look at my notes here. We are broadcasting coast to coast tonight. So we've got people, I can tell on here in Nova Scotia, people in Toronto, people in London. I think a young man from Florida might not be on quite yet, but soon will be. And even internationally, we have someone from Costa Rica coming on tonight. I can't tell may already be on. So our webinars are getting a little more popular. They've now gone international. I think we did the last webinar on my birthday, December 2nd. Matt just celebrated a milestone birthday on Sunday. Donna celebrates a birthday tomorrow. So best wishes to both of them. You can extend some birthday wishes with a text or something if you want. We're going to be posting tonight's webinar on our website. The one that we did in December from CI will also be on there. The delay is compliance. Matt and I would like to have far more of these on, but as you all know, compliance and liability is their number one concern, but that's what our intentions are. Anything to add to that, Matt?
No, it's a couple layers of compliance from our compliance and the company that presents compliance. So it's we'll get them on as soon as we can. This one should be a little quicker because it's just us.
Yes, it is.
Yeah.
So we're hoping so. And along that note, we're going to start some short videos on our website in the near future. Little snippets and reminders. They won't be cat videos. They'll actually be applicable to investments, and we're going to try to make them interesting and keep you on our website so we can actually post a little bit of information on there about markets and deadlines and those kind of things. So okay, Matt's still admitting quite a few more people, but I think we're going to start anyways.
Yeah.
So Matt, for the agenda, maybe I'll wave at you for moving things along.
Sure.
And we get started. Any more housekeeping that you can think of?
We do have the Q&A feature available tonight. So up on the top center left, you'll see the Q&A bubbles with the question mark. If you want to ask a question, we really hope we get some tonight. Just click that and then it'll come through. It takes 20 to 30 seconds for us to get the questions, but then we'll happily answer any and all that we get. So we can start.
Okay. So I have a continuing series on emotions. You'll also hear me quote the late, not quite late, but still the great Warren Buffett, who retired on Thursday from chairman of chief executive officer of Berkshire, but still chairman of the board. He's only 95, so he has no reason to step down from the board. And he says, as all of you will surely remember by now, the number one factor on how your investments turn out and your retirement plans is your emotional stability. You are the biggest factor in determining the outcome of investments, not the market, not the fee, not the time of the year, not the timing, but your own emotional state. So once again, title is Managing Emotions, Part 6 of the continuing series. So Matt, the agenda tonight. Okay, so that's loosely the agenda. We're going to talk walk the walk, what we do to keep your money safe and our outlook, what's next to how we're going to handle it. Not on there, and Matt's going to talk about seg funds, how we can have a product that's absolutely 100% guaranteed, and is part of our action plan to keep your money safe. Okay. So walk the walk, kind of like the great Don Cherry said years ago when he used to present Coach's Corner, and we all have to be accountable. I believe that from day one, that we live and die by our predictions around here, and not so much predictions, but how we actually manage money. So I think we have to show a record of how that turned out each year. If it didn't turn out well, we have to man up and address that. So to get started, get my slides here. Okay, so last year we talked about a contrarian philosophy, which means we try to take a position against the prevailing wisdom, not exactly against the facts, but the news of the day. We don't follow fads, late cycle investing. We like some bonds first time in years, the last couple of years, smaller equities, and of course those dividend payers. Okay. It's important sometimes what you don't do, or maybe even more important. Buffett's famous rule number 1 is don't lose money, and rule number 2 is referred to rule number 1. So sometimes avoiding risk is just as important as the opportunities. We thought real estate still had excessive risk because of the leverage. And we wanted to avoid that. Bitcoin, just too volatile for our own making here, and just so you know, we don't take Bitcoin here at Thamesford Wealth or Thamesford Accounting. It's Canadian dollars. We're not ready for that. China, we don't want to be involved with for political reasons. Their real estate market is still way over levered, and we want nothing to do with it. And of course, cash. We want to avoid cash because there is zero return on cash, and our idea is to achieve returns, positive returns. The great Buffett has said he doesn't like T-bills. He favors equities and owning companies over cash. Real estate was unsustainable. Remember, as always, avoid the herd. So that's what we said last year. So how did things turn out? Okay, so part of walk the walk is to see how the results of that turned out. So that was a current portfolio. Not everyone has this. That's not exactly what we recommend for everyone, but that's some of the major funds we have here. First one, Canoe Asset Allocation, is partially bonds and partially equities. Matt, what's the split right now?
It's 50-50 on that one right now.
Okay, so half of that fund is bonds and half of that is stocks. 7.6 last year, and these are calendar year for 2025 results. And that's basically the long-term average, and that's what we hope to achieve. A little later on in the program, we'll explain why we have chosen this portfolio. Shockingly, Canadian banks were only up 41% last year. Led, of course, by the great TD. We're going to talk about that later on. It's just an absolute miracle how those banks achieve those kind of returns year after year. Fidelity Dividend, which is now our largest holding here at Thamesford Wealth. We have more money in the Fidelity Dividend Fund than any other fund, up 18 last year. Global Small Cap Opportunities. And what does small cap mean, Matt?
It'd be less than $5 billion in market cap internationally.
Yeah, so the value of the company itself would be less than $5 billion if you bought all the stock, all the shares in that particular company. So a company like Royal Bank, I think, has a market cap of 80 billion or something.
Yeah.
I unfortunately know the US one's better than Canadian. So it's the smaller companies. It was up 3.3. More to that later on in the show. Fidelity Global Equity Plus is actually 3 Fidelity funds merged together, you might call it. So they own equal parts. And which funds, Matt, are the Equity Plus?
Global Innovators, which is a more aggressive type fund. Fidelity or large cap, and Canadian Opportunities. So they paired 3 managers together. One guy is very kind of techie focused, aggressive, moves quickly. Most of our clients couldn't handle his volatility on their own, and they paired him with 2 other gentlemen One guy is kind of a contrarian investor, and then one guy is always waiting for the world to end. So they've made a very good tandem of portfolio managers that we really think fits our clients' portfolios.
Yes, and it also has superior downside protection. We'll talk about that more in the program when we talk about what we're going to do for 2026. And then Mackenzie Global Dividend, as it shows, it's dividends of companies around the world, not just Canadian, not US, but truly global. So if you added those together and had an overall return, I think it's around a little under 15.5. We'll call it 15.5%, which surprisingly or not, is equivalent to about the 3-year return of those funds together. You'll notice Fidelity Global Equity Plus does not have previous returns, even though those funds all existed for in excess of, I believe, 20 years each.
Yes.
But they hadn't put them together. So once again, for compliance, they're not allowed to show that. We'll explain a little later in a few minutes why we have those particular funds. So you could grade us on that, whether or not that's maybe a B if we had the Mag 7 as they talk, Microsoft and Apple and Facebook and those. You would have done better with tech last year, but unfortunately experienced far more volatility, especially on April 6th with Liberation Day. So that's the walk how we fared last year. And you'll also see those funds since inception have all been pretty solid players, because some of those funds have existed. Obviously, Canadian banks have existed for since the 1800s, the late 1800s. So, okay. So, walk the walk. Okay. Now, excuse me 1 second, I get my agenda, my notes here. So for our outlook, there's a number of factors that are at play at any given time. So I've tried to highlight some of the more important ones. So number one, I'm sure on everybody's list these days, is the geopolitical landscape. So one infamous Donald J. Trump of the US president at the moment, and we'll get more to that a little bit later. His health is in question, and I mean in addition to his mental health. So we'll see. We've got bets here in the office whether or not he survives to the end of 2026. So surprisingly, there is a very, very, very low correlation between presidential activities, political events, and the market. That's because there's a very low correlation between the market and the economy. So that's why many people don't do as well as they think they should in the market, because they're always following current events about what's happening in the economy. And actually, it's a very, very weak relationship to the stock market. It's two different things. And we'll talk a little bit more about that in a minute with sentiment. So I'm not too worried. Here at home, we've got Carbon Carney has replaced a child. So we have a little bit more confidence, I guess, in the Canadian economy. We've got a man that really didn't take the job seriously, to a man that's very pro-business. We'll see how he fares on environmental issues, as in the pipeline, which because of yesterday's events with Venezuela, Poilievre, the conservative opposition leader, is pushing him to fast track that pipeline and let's sell oil while we can. But at very least, the Canadian outlook, regardless of the US, is a little bit more positive because we have a more pro-business stance in Canada. Would you agree or disagree, Matt?
Absolutely, I would agree. Yeah.
Okay. Obviously, the weekend's events with Maduro, if I said that correctly, who'd been the acting dictator, I think about 20 years since Chavez had, I guess the word is, ruled the country as a dictator for the last 20 years. The infamous Mr. Trump has deposed him, and that is going to change, obviously, events in the oil market, and we'll see how it goes politically. We've had a little bit of panic in the last 2 days in the Canadian oil market, but the reality is it will be years if any additional oil comes out of Venezuela. I'm told the infrastructure is over 50 years old and none of it's been upgraded in at least 30 years. So I think the actual fallout from Venezuela will be far, far, far less than expected. So interest rates. Interest rates have been easing off since this time last year. The outlook is for rates to be, I'll say, softer at the moment. They're arguing whether or not to be further cuts. Probably not in Canada. Possibly one or two in the U.S. Donnie is pushing for a new chairman of the Federal Reserve. That's a little bit more dovish. That would lower those rates. The late great Marty Zweig, that you may or may not recall from Louis Rukeyser's Wall Street Week, always said, "Don't fight the Fed." Marty was one of the greatest traders of all time. I never forgot him saying that. Admittedly, was 30 years ago. So that's a little bit of a tailwind as well. We also have profits. So the market follows earnings. The market follows profits. In the short run, it's a very loose relationship. In the long run, it's a very positive relationship. So corporate profits in the U.S. at least are very strong. They've been surprisingly strong for most of Canadian companies. Obviously, a few as in lumber companies and maybe some of the steel companies. I'm not exactly sure where that falls with the tariffs, but in general, the earnings have been pretty good. Those are all really good tailwinds for the market. When you've got earnings and a very soft interest rate environment, very what they call loose monetary supply, keeping things liquid, that's actually very sanguine for the stock market. Any comments on that?
No, I think in Canada, you've seen the main industries in Canada, financial and energy, their earnings have been strong. Even with some of the banks taking loan loss provisions or increasing those, their earnings have continued to be very strong. And then energy sector, the energy companies in Canada have been paying down their debt so aggressively that they have a lot of cash and earnings are doing very well on that side.
Okay, that's the good news from tailwinds. Now a few headwinds. Number one would be valuation. Stocks are not cheap. I believe on a current price to earnings ratio, you're talking about 28. Which historically is on the high end for the New York market. I do not know the number for the Canadian market. We don't follow it quite the same in aggregate as the U.S. So things are just not cheap. The Shiller Index, the CAPE ratio of the cyclically adjusted price earnings ratio is almost as high as it was in 2000. It's based on the fact that companies cannot sustain the margins that they have at the moment. However, with artificial intelligence and machines to some extent replacing workers, hopefully my staff can't hear me, but machines don't get sick. They don't worry about getting fired. They work 24 hours a day, and in many cases are quite efficient. So that may keep those margins up, but valuations are not cheap. Secondly, is sentiment. So Matt has just put a chart up now. Market sentiment. For those of you that follow me for some 25 plus years, know I'm a big believer on market sentiment. We all remember August the 12th, 1982, which was coincided with the bottom of the stock market in New York, and the bullish sentiment there was at an all-time low. It was in single digits, so out of 100, it was below 10. Which meant 90% of the people thought the market would go substantially lower and only 10% higher. And of course, we all know that was the bottom of the market, and the market is some 60 or 65 times as high as it was in 82. I think that's the lowest number I've ever seen. I followed it for 40 years. So we're now in the reverse. So the sentiment is a little euphoric. You can tell on your screens there that we're in the blue. It's not cheap. If you look on the chart there, back in April, and that probably coincides with the April 6th Liberation Day, when everyone thought the world was ending, when Trump put on the tariffs, was actually the buying opportunity of, I would say, the last 3 years since 2022. So sentiment's a little too bullish, valuation's a little too high. I also believe we might be in an artificial intelligence bubble. Artificial intelligence is going to change the world the same way the internet has. Judy and I may be in Florida in a couple of weeks. If there's one of those test cars of Waymo, which is the autonomous car by Google, we are going to take it. And statistically, a Waymo car is 96% less chance of an accident at an intersection. But unfortunately, people have bid artificial intelligent companies to the moon, and some companies are spending like drunken sailors. So Oracle, which for a few minutes made Larry Ellison the richest man in the world, have 248 billion in lease agreements. They only do 61 billion a year in revenue. So these people are really mortgaging their future on AI, and that, like 2000 in the dot-com era, is not really expected to turn out well in our end. So I'm worried about an AI bubble. Also, cryptocurrencies. So there are actually over 10,000 different cryptocurrencies, of which Bitcoin is one, and it's by far the major one. And there's 2 or 3 trillion with a T involved in these currencies. One that I call Doggy Coin, it's a DOGE coin, started as a joke, has 2 or 3 billion in that currency. It has no intrinsic value whatsoever. Someday these currencies will go to zero, and that will be, as Ross Perot said back in, I don't know, I think 84, a big sucking sound as that money leaves the industry. So that's kind of the plus and minuses for the outlook, and how do you want to interpret that? So we get the question then, if things are valued high and the sentiment is high, why don't we just get out of the market? Why don't we just wait for something to adjust? Sounds good on paper, but unfortunately very hard to predict. And actually, if anybody happens to know the odds of 4 consecutive years of gains in the market, it's happened 7 times out of the last 50 years. The average gain, I think, is between 10 and 12%. And we don't know from where. We might have thought last year with Trump might have scared everybody out of the market. You would have missed out on one of the best years we've had in the last decade. So it's very, very hard to predict it. The other thing is, it's not just a stock market. The stock market is a collection of some of the greatest, strongest, most endurable companies in the world. So people don't stop using products such as fuel for their car. Everybody shaved their, well, not everybody, half the people shaved this morning or not. For Gillette, people are still eating hamburgers. People are still going to the grocery store, to the drugstore. They still bought computers. What else do people do, Matt?
Well, buy cars, buy clothes, spend money on entertainment. It's no shortage of spending out there with the consumer.
Yeah, so those don't change. So the facts are, even recession, a company's earnings may fluctuate 5%, but the market fluctuates much more than that because of emotion, right? So we have to put that into context. So the other thing is, Matt, I think maybe another slide down in there. Okay, let's remember, the market is up 3 years out of 4, right? So the statistics are overwhelmingly on our side. So Matt, you're a sports guy. What's a really good batting average in baseball?
250.
Okay, so that means you're wrong 3/4 of the time. Is that correct?
Yeah.
So what if you're right 3/4 of the time?
750.
Okay, yeah. Yes, it would be. So that would be pretty good. 3 years out of 4 is a 750 batting average, which Buffett would tell you is phenomenal. So strictly by the odds, remember the market is up 3 years out of 4 and substantially. So I'm going to put my glasses back on here. And the worst market of all time was 1931, started the Depression, and the market was down about 40%. And you'll also notice 2 years later in 1933, it was up the most in history, almost 60%. Because we have to remember the best days and the best years follow the worst. So statistically, that would be our inclination. Okay, but the consequences of missing out by trying to time that market are horrendous. So out of the last 25 years, and you could go back much longer periods, it doesn't really change much. It had an average return of about 7.7% in the market. If you miss the best 10 days out of 25 years, it cuts your return almost in half. if you missed the best 50. So if you missed the best 2 days per year, the last 25 years, you would have actually lost money. That's why it's extremely difficult to tell. So it also means that when we have exceptionally bad days, Buffett and Matt and I and Donna think that's the best day of the year because that's the day that you buy, because the best days follow the worst days. Okay, any questions yet, Matt, on
I don't see any questions yet. So folks, if you do have a question, you can just go up to the Q&A widget on the center left of the screen and type in a question, and we'll get it answered for you.
Okay. So any really good questions, and for compliance, I couldn't, we're not allowed to say, but you know what, we might throw you know, your name in a hat for a Tim Hortons card or something like that. So that's the overview. What I see good and bad, and I don't know where I'm kind of mixed emotions on that. But once again, it's the action that counts more than the sentiment. Because remember, on CNBC, and we have people call us and they said the world's ending. The world does not end. And if you wait half an hour, somebody has a contrary opinion. Because remember, it's just news to sell newspapers. Okay.
Yeah, and just I'll say to that point there, the S&P 500 last year had a maximum drawdown of 18.9%, I think it was.
I think it's a liberation day.
Yeah, so if you panicked and sold in April, the rally back from the lows from Liberation Day, the S&P 500 finished up just under 18% for the year. So almost a 40% swing between the low and where it finished in the year. So it does pay to stay invested and trust what you own.
Okay, now I might have to flip these slides around a little bit, Matt, because I changed my mind a touch, just to the contrarian slide. Here we go. Okay, so opportunities. Anyone that's followed us for any length of time knows that we're contrarians. Once again, that is a opposite action or opinion to the prevailing wisdom. Prevailing wisdom doesn't mean that it's wise. It would be the trend of the moment. So once again, we go against that trend. The great Buffett says to get greedy when everyone is fearful, which when the market's euphoric. When the market's fearful, when we have a panic, that's the time to get the checkbook out. When the market goes down, you want to throw a rock through our window. That's what we want to check from you. It also means when things are euphoric, we want to be careful, which means things are expensive. And remember, value and price are opposites. So the higher the market or the price, the less value you have. When the market drops and it's cheaper, the more value, because you're buying the same company for less dollars. So we always want to be contrarians, and I think in general that served us well. So as a contrarian now, what would be cheap or where would the opportunities be? Well, in my opinion, there's no what they call fat pitches at the moment. We all know that in August of '82, when Bell Telephone was trading for a few dollars a share, and dividends were 11 or 12%, that doesn't exist today. Oil went negative. Contrary to what somebody said on CNBC this morning, they had the wrong year. I believe April 20th of 2020, just as COVID had started. Oil went to a negative number for about an hour. Tanks were full. They didn't know where to get it. Oil companies were trading for pennies. That was the opportunity of a lifetime. Some of those companies that we were lucky enough to owned have gone up 50 times since that. At the moment, I don't see any of those fat pitches. However, there's still opportunities. One is oil right now. Oil is already cheap. Didn't do well last year. Yet our energy fund, I think, was up 28 or 30%.
Yes.
The Canoe Energy Fund.
Yes.
So there's still opportunities in companies. As Matt said a minute ago, these companies have really wised up and they've taken the profits and paid down their debt. That's why these companies at a lower oil price can actually make more money. Then add in Trump's actions on the weekend of deposing the dictator in Venezuela, and that heavy oil would compete with Canadian oil. So the world is ending today for Canadian oil companies. But the reality is it's not ending. That's the news, that's the panic. So we have been looking at buying, and for compliance, we can't name stocks, but obviously we've been buying oil and oil funds on that news. So I do think that's an opportunity. Small cap equities are undervalued. So Matt, I might take a few slides back to our walk the walk.
Sure.
If we can get back to our outcome last year. Okay, so you'll notice the Fidelity Global Small Opportunities only went up 3.3%. So also you'll notice that its historical run is over 21. So last year it was out of favor. Most of the clients would say, man, I want to do it the best. I want to buy those banks. Well, unfortunately, banks have had a couple really good years. So we've really stopped buying banks until we get a bit of a pullback because there's no longer as much value because the price is higher. The smaller companies, though, are making money, but for whatever reason, everybody wanted big companies and AI. Barely up last year, and they are very, very cheap. In fact, they've been out of favor for a few years. So they represent great value. So as contrarians, we're looking to buy smaller cap companies, not chasing those larger cap companies, which are overvalued. So as I said a few minutes ago, we would get back to the slide. I was worried about valuations. We are not worried about valuations of small cap. We see it, no pun intended, but small cap opportunities as an opportunity. We also like international. The US leads the world. Every discovery in the world basically comes out of the United States of America and Germany. Unfortunately, and they've been world leaders and they're proud to tell you that. But it also means things aren't cheap because everybody's been following that US market and valuations are high. It also means people have been ignoring more global international opportunities. So they're cheap because nobody had been following that. So some of them are undervalued. So we like that McKinsey Global Dividend Fund. So anything global is relatively good value. We do.
Yeah, absolutely. Yeah. The international markets have lagged behind the US and there are some really attractive valuations there.
Okay. So you can go back to our slide there for our focus or areas to favor, I guess. Yeah. So small cap are undervalued. Precious metals. So everybody's following gold and silver. Everybody on the call tonight, I'm sure remembers Bunker Hunt. Bunker Hunt in 77, 78, 79 tried to capture, I guess, the silver market. And silver went from $5 to 50. And unfortunately, unsuspecting to Bunker, everybody decided to melt down Grandma's silver tray and take the money while they could. And silver collapsed back to a few dollars an ounce. Silver, as of today, is over $80. It's everybody has just discovered silver in the last couple of months. Gold is also at basically an all-time high of $4,500. It's a good hedge against credit crisis and world debt at the moment. But we also recognize there's a very, very low correlation between the price of gold and these other factors of debt and markets in the short run. But we're going to look at precious metals if it looks like we're going to be into some kind of a credit crisis. Okay, also bonds as an asset class and diversification. So Matt, if you can go back, sorry to run you around here tonight. Let's go back to that that one chart. I can't tell because I changed the chart numbers here on maybe not. Maybe we're going to have to go ahead. There you go. Okay, so that is a scatter plot. So one of the reasons of diversification is to lessen the risk of picking the wrong fund and putting all your eggs in one basket, as they say. So many of you have seen this when we do reviews. Those dots on there are your particular funds, and the square in the middle is the TSE and a 3-year return, Matt?
3 years, yeah.
3-year return. So you'll notice that most, except for the one in the, I don't even want to call that pink or red or whatever color that is in the far right.
Which is the bank's fund?
Which is the bank fund. So the riskiest fund is the bank fund. We'll get to that in a second here. But to the left of the box is less risk. So if you're the extreme left on there, that would be government treasury bills or your savings account or money that you've loaned to your teenager, something you're sure you're getting back. And to the right would be investing in world markets such as China, emerging markets, or frontier markets in Africa. Very, very risky and a much lower chance of recovering your money. And And probably that's where your loans to your teenager would actually be on that side, all kidding aside. So the banks are over there for one reason. Makes no sense because of the largest companies in Canada. They're the most profitable. They pay virtually the best dividends. They've been around since the 1800s. Excuse me 1 second here. Slow your motion. Unexpected visitor. But they've done so well, they have determined that they're higher risk only because they've done so exceptionally well. They're out of their band, which is ridiculous. So that doesn't bother you to bet. Obviously, the Canadian banks are not a high risk investment. Okay, so when we looked at that walk to walk, so back again, I know we're going back and forth. Hopefully, you're not getting dizzy, folks. Okay, so if you look at canoe asset allocation, half of that is bonds to start with. So very defensive. The Fidelity Dividend Fund, does it have any fixed income at all in that?
No.
Everyone has to be a dividend payer?
Yeah.
Okay, but income oriented, and obviously the Canadian banks are dividend payers. So we use the kind of the lower risk on the scale there to own banks, dividend payers, and bonds, as opposed to growthy companies, because things are not cheap. So if we have a big pullback in the market over the next few years, we will not be focusing on them. We'll be focusing on growth. So that's why if we underperformed the benchmark last year, we took a little more cautious stance based on back again. Next year, I'll know to put it in double the slides so we don't have to do this. Which one? Okay, there's scatter plot. So you'll see most everything is to the left of the Toronto Stock Exchange. So at the moment, we want slightly less risk. In fact, if you look, the Toronto Stock Exchange is at least a quarter more risk or more volatility. And so we've given up just a little wee bit of return for a lot more downside protection. So if you're a global equity fund, what's the downside protection on it?
So I believe the downside is 65%.
Somewhere around.
Yeah.
What does that mean?
So if the market goes down 10 and it has a downside capture rate of 65%, that means the fund will only go down about 6.5%. So you'd be ahead versus the market, which is what we aim to do.
Yeah, so if the market's 100, it only goes down about 2/3 as much.
Right.
So in the long run, by playing defense, you do two things. First of all, hopefully come out ahead because you haven't given up. But more importantly, you stay according to your plan. You don't get shaken out of the market. Remember, the market, as Buffett will tell you, is designed for the money to go from the inpatient to the patient. So people that get scared out of the market because of volatility, doesn't do you any good if the market goes up if you've already sold out. So that's why we try to err on the side of more conservative. In the long run, we believe we've achieved just as good or greater returns. Okay. I guess you can just move ahead and just about out of time for myself here. So dividend growers, bonds are the inverse of interest rates. We're going to see where they fit in depending on how this market goes. Precious metals, if it looks like we have a debt problem. And then seg funds, which Matt's going to talk about in just a few minutes, guarantee your funds to the next generation. History doesn't repeat, but man always does, which means this time is not different. People still succumb to the same greed and fear. We want to make sure that that we do the opposite or contrary to that. That when people are fearful, that's when we want to buy, and when they're euphoric and throwing caution to the wind. And this business has been a pretty good indicator. We want to take more risk after the market's gone up. We should be taking more risk when the market is down. So we remember that's one of our mottos here. Never and forever is 2 years. Recognize the guy that said that. So memories are quite short, and most people can't take it after 2 years, or if it's been going up for 2 years, if they think it's always been like that, and nothing could be further from the truth.
I'm confused about myself, so it's not my forte, I guess.
Right.
Yeah.
Can't see everybody, right?
Yeah, that's right.
Okay, that just about wraps up. Any questions there?
No questions as of right now.
Okay, folks, put a question in there. Maybe we'll, I don't know what we'll do. We'll do something. And once again, I said areas to avoid are also interesting. So people in these times always look for something else. So watch out excessive leverage. Inflation is inevitable. So one of these days rates will be going back up. Private equity and private credit. Institutions have been doing this, and now some of that they're selling off to the little guy. Be very careful with that. Don't chase the AI bubble. I mean, it's already baked into the price. I mean, some of these companies are like the .coms and trading for 100 times revenue. So just be a little more discerning. That's basically what I have here for our outlook.
All right. So move on to talking about guaranteed investment funds.
Yes.
Yeah. All right. Just give me a second to change our presentation here, folks.
Huh. And please, while Matt's getting ready here, think of some questions for us. We're glad to make this interactive as we can.
Sure. All right. Looks like we're good to go. So yeah, we wanted to talk again about guaranteed investment funds or seg funds as they've been known for I guess the last number of decades. Guaranteed investment funds to me is a more apt name because it describes exactly what they are. So we'll talk to you about what the benefits of a guaranteed investment fund would be, and also how they can assist you in estate planning. As you know, we do really like to talk about estate planning with clients. It is a need that everybody has right now. So we just want to make sure everybody knows where you need to start with estate planning and how this can be or guaranteed investment funds can be a very useful tool. So we'll just talk about what is a guaranteed investment fund, how does it benefit your estate, some portfolio investment options, and then we'll just run through a client case study that would kind of show you where the benefits would lie. So what is a guaranteed investment fund? So the best way I like to describe a guaranteed investment fund is it's essentially a mutual fund with a life insurance contract wrapped around it. So it is a life insurance product. It does have guarantees. It is covered by the life insurance regulations. And because it has a life insurance contract wrapped around it, it does have a little bit of an extra fee, but those fees have come down dramatically over the last number of years. Eh, Daryl?
Substantially.
Substantially, yeah. Yeah, if we were looking at this 15, 20 years ago, we probably wouldn't be as interested in guaranteed investment funds for our clients, but now that the fees have dropped, they are an attractive vehicle.
Absolutely.
Guaranteed investment funds do have guarantees baked into them. Well, I'll talk about those in a bit of a area in a second. You can see kind of where the differences would be. So both mutual funds and segregated funds or guaranteed investment funds are available in all plans. So you can buy them in TFSAs, RSPs, RESPs, RIF accounts, and open accounts as well. They have a wide range of fund options. You can access your money at any time. So they are completely liquid. If you put in some money one day and you need to take it out a couple of days later, you can do that. That is no problem. You have full access to the investment in a seg fund. You do with what the benefits of a seg fund would be are guarantees that I'll talk about in a second. Investment growth is protected through resets, which I'll also touch on a bit further. Possibility of no probate fees, a quick settlement on death. They are creditor protected, and you definitely do have a really beneficial estate planning tool here. So capital protection. With the guarantees, there is a guarantee of a maturity benefit or a death benefit. So there's really two popular guarantees, one that they call 75-75, which I believe I'll just talk about here. And the first number would be the 75% guaranteed at maturity, and then 75% guaranteed at death. The more popular option that we are more interested in would be the 75-100 contract, which has a 75% guaranteed at maturity, and 100% of your principal is guaranteed at death. And resets are available on those as well. So how does a reset work? So for most companies that offer seg funds, they offer resets until age 80. So if you made your initial deposit of $100,000 in this example, and it grew up to $145,000, you would have a reset every year. It's an automatic reset on the calendar, on the contract anniversary date. So if you bought it on April 1st, 2025, April 1st, 2026, you'll have a reset to the higher of market value or your deposit and then April 1st every year until you reach age 80. So in this example, resets are applicable and at $145,000. The market drops and the value of the portfolio drops down to $120,000 when the client passes away. So at that point, you have a guaranteed death benefit of $145,000, and the market value is $120,000. So there's a difference of $25,000. So your beneficiaries will receive the guaranteed death benefit amount of $145,000. So you're really taking out some of the worry of a market correction affecting assets that you want to leave to your beneficiaries. Okay. And again, if you have any questions, please ask away and we'll answer them. And how do GIFs or guaranteed investment funds benefit your estate? Well, the biggest thing with settling an estate today in Ontario is the time. So with a normal financial institution, for open money, so this is talking about accounts that you do not have a named beneficiary on. So your RSPs and your RIFs and your TFSAs will all have named beneficiaries that will receive the account value whenever you pass. This would be for open money or non-registered money that doesn't have a beneficiary attached to it. If you pass away with no beneficiary, it will go to your estate and it will be divvied up by your will. So that may bring in probate. It will require an executor, require a couple of tax returns.
Yeah, well, the best money you could spend is on accounting, so.
Yeah, so all that takes time. So you're looking at, 12, in Ontario, 12 to 18 months before your beneficiaries will receive any of those funds. So it really is critical. And if any of you out there have been an executor and you know how much work settling an estate is, if you're honored with that task.
So Matt, if you have an open money and someone and the owner passes away, is that subject to probate for the estate?
It would depend on the amount. Right? If it's over 50,000,
okay,
then yes, it would be subject to probate, and the financial institution would probably require it at that point.
Okay.
Sure. All right. So because seg funds are an insurance product, you will have a beneficiary named. So even with non-registered or open money, you can name a beneficiary. So when you pass away and we get the proper paperwork, we're able to process that death benefit to your beneficiary in as little as 5 days. I'd say more like 2 weeks, but it's very quick, and we have had real life situations over the last 6 months.
Yes.
Where the settlement has been, I think it was 6 days.
Yes, practically instant.
Yeah. So you really do shorten the estate settlement process for your beneficiaries. One other strong thing with seg funds is the privacy that comes along with them. All beneficiaries are confidential. and so are the amounts you leave to the beneficiaries. So if you have multiple children and you don't want to leave money to one of them, that's no problem. You can do that with a seg fund contract. Nobody will know unless they tell each other themselves, but as per the contract, it is all confidential. So you can feel comfortable knowing what you're doing is going to be according to your wishes and kept confidential. There is also what they call an annuity settlement option that is a benefit to what we call at-risk beneficiaries. So if you have a child that isn't very financially literate, or if you have a disabled child that you'd like to leave some money to, you're able to set up an annuity for the amount that they're going to receive from the seg fund contract. The annuity will be a life annuity, and it will pay a certain amount out to that beneficiary every year for the rest of their life. So it's a really strong benefit that deserves some consideration if you have an at-risk beneficiary. So portfolio investment options. This is an area that, again, has gotten very strong with the progression of seg funds. You'll see there a lot of the companies that we use regularly, Fidelity, Canoe, CI, they all offer funds through their seg fund version. So you can get very well-known, well-established funds just in a seg fund version, and we're very comfortable with that. Empire Life is a company we feel very comfortable with, and they have many fund options as well. They're a smaller life insurance company based out of Kingston, Ontario, that has been great for us to deal with.
I didn't know they were Kingston.
Yeah.
Home of Wayne Cashman.
So we'll just go through a quick case study here, just to kind of illustrate a real life scenario. So here we have a married couple, Justin, 65, and Sophie, 63. They have 4 adult children. They have 400,000 in RRSPs, 220,000 in TFSAs. They just sold some property where they have now $2 million that they've invested in a mutual fund portfolio, and they have a house that's worth 500,000. So each spouse has the other named as the beneficiary on their RRSPs and their TFSAs. The mutual fund portfolio is held in those letters that mean joint with right of survivorship, which means that when one passes away, it just transfers to the other holder. So in this scenario, Justin passes away suddenly. So what would happen when Justin passes away? Well, all the RSPs and the TFSAs will just transfer to Sophie, as she is the named beneficiary. And the mutual fund portfolio, since it's held joint with right of survivorship, will just transfer solely to Sophie's name. So there's not much concern in married couple whenever everybody has named beneficiaries and everything is planned and taken care of appropriately. And I will encourage you to always double check your beneficiaries and update them accordingly. So we move forward 7 years. Sophie is now 70 years old. She has the same 4 adult children, now has 5 grandchildren. Her RSP has grown to $700,000. Her TFSA has grown to $350,000. Mutual fund portfolio is now $3 million, and the house is worth $600,000. So the 4 children are named as equal beneficiaries on the RRSP and the TFSA accounts. Sophie passes away. So in this situation, the RSP and the TFSA, once we receive proper documentation, will be paid out to the beneficiaries. Of course, there will be some taxes withheld on the RRSP, but the beneficiaries will get their money in a relatively quick fashion. The $3 million mutual fund portfolio, since it's held in Sophie's name, that will be going to the estate and administered by her will. So as long as her will is up to date and spells out exactly what she wants, then that is the money will go according to her wishes. And the house will also be administered to her estate. So now that will require an estate settlement process, which probate would be highly likely in that situation. And is going to take quite a bit of time to settle. Again, Ontario, 12 to 18 months, fair to say, Daryl?
Yes.
So if we had that $3 million in a guaranteed investment fund portfolio, so everything else stays the same, the $700,000 RSP, the $350,000 TFSA, but you just have that $3 million in a guaranteed investment fund portfolio, that will now have named beneficiaries on it. So all 4 children will be named equally on the RRSP, the TFSA, and the gift portfolio. So all of the funds, once we submit all the paperwork, will be paid out to the beneficiaries within a couple of weeks at most. So it is going to save over a year in the estate settlement process. It's going to save your executor quite a bit of hassle, and you're going to probably save some costs as well. Fair to say?
Yes.
Yeah, good. Anything you want to add?
Well, 2 things. I'll wait till you're done here.
Yeah.
The one thing people probably underestimate is the time it takes to settle. It's not just the beneficiaries can't receive their money, is the opportunity cost of not having the money.
Yeah.
So when the bank pays nothing in the estate account at the lawyers, that takes a year, you have foregone a year's interest, or you didn't pay off your credit card. So you're not long at, you can pick the rate, whether it's 5% it cost you for the year, or 20% if it was in the market. You certainly have paid for those fees, which would be roughly what, maybe an extra 0.5%,
Yes.
3/4 per year.
Yeah.
So once again, the opportunity cost of money being tied up too long is far more than the actual cost of it. I had a question about how the contracts work, but I'll wait till you're finished.
Well, almost done here.
Okay.
And we're coming up on 8 o'clock, so I want to get everybody stick to our timeline. So 5 reasons to consider guaranteed investment funds. The estate planning benefits, quick settlement to your beneficiaries, the confidentiality, the capital protection. So if you put in $1, you know that your death benefit will remain that amount. The death benefit grows with your resets, which are again automatic and annually every year until you're age 80. You have access to the same top portfolio managers that we use on the mutual fund side, and of course creditor protection. So I don't think anybody really has to worry about that in our clientele. A few points to remember when planning: estate settlement, final expenses. So it is a little bit possible to overplan and have everything bypass your estate, but your estate still will have some final expenses that you have to account for. Capital gains taxes. So if you currently have, non-registered money that you're thinking that this would be a better option for, there will be some capital gains taxes implications that we will definitely walk you through and help you out with. And again, it doesn't have to be a all one-time thing. This can be part of a planning process that works out over a number of years. So yeah, guaranteed investment funds are part of an overall financial and estate plan. They don't have to be the only part of your plan. They are a piece that we can use as part of the overall financial plan for you, an estate plan.
Absolutely, and one of the reasons we're interested in them now is the market is not cheap, and people at a reasonable age, that if they're not using that principal, they sold some properties. Most of the time, that money is going to go to the beneficiaries. They want it invested, but they don't necessarily want to take a loss on that. They may not believe they've got the time to recover.
Mhm.
So that's the advantage of passing to the next generation. It is guaranteed. And one quick question on the contract, if you can just back up a little bit here to the original slide on the couple. Okay, so how easy can the contracts be changed? Just hypothetically, if Sophie kicked out Justin and, say another woman come along, say Katie, what does that do to the contracts?
Well, you can You can collapse a contract if you want. You can change beneficiaries of contracts as long as when you first set them up, you have to set them as revocable beneficiaries. So irrevocable means you cannot change it without the beneficiary's permission. Revocable means that you can change the beneficiary whenever you want.
Okay, what's the odds of that happening? So if you're kicking out this Justin, a new woman, say Katie comes along.
Well, it seems like 100%.
Okay, good
Yeah.
to know. Good to know.
I was going to change it to 80, but she's not 63.
Well, we had to have at least one political commentary, folks. I think I've been on my best behavior tonight, actually. Okay, anything else before we wrap up here?
No, I don't see any questions yet.
I'm a little disappointed that a few of our regulars, Scott, if you're on there, certainly to goodness, there's something you would like to know, or John, feel free to ask us. We appreciate everyone's time tonight. So in general, the market is still statistically positive for the year. Our plan doesn't worry too much about where it's going on NBC. If I make a call for the end of the year, if Buffett doesn't know what the market's going to do this year, we certainly don't, and it really doesn't affect our long-term planning, whether it's up or down. We do want opportunities. I think oil might be cheap. I think AI might be a little overblown. I think there's no intrinsic value to crypto. Doesn't mean it's not going higher. It's hard to beat dividends because it means the company is profitable for a long time and pays back to shareholders. And the dividend alone will help any pullbacks in the market. Small cap is definitely cheap compared to large, and we want to add a sleeve of that to portfolios. And the one at Fidelity has a very, very, very good downside capture, which means if the market backs up, it statistically backs up less than the market. As the market goes up, it goes up much more than the market. It's kind of nirvana. Nobody will want it because it only did 3% last year, but we all know as Buffett disciples, that's the time when you buy it. So still no questions on there?
No questions at all.
Goodness.
But if you do have questions tomorrow, please don't hesitate to reach out to us. We'll be here all day.
Yes, we're going to try to post this on our website along with, in the future, more webinars, a little bit more information, what we're thinking, some snippets on there, maybe a cat video, I don't know.
Yeah.
Whatever.
And feel free to share the recording if you think somebody would benefit from the information. We're happy to help anybody out that we can.
Yeah, so the links are, I think Matt also has these on Facebook, and he's maybe eventually Instagram or something.
Yes.
But they're encouraged for anyone to have these. So one time you can share the link, encourage people to go to the website, and if you have questions, obviously at any time, call us or email us, and we'll do our best to answer them.
Yeah. Yeah, and like us on Facebook as well, Thamesford Wealth Management.
If you're on the website, we will be soon making it available that you can leave a review.
Yes.
Thamesford Accounting, you can. Also, those of us that are on Thamesford Accounting website, please leave a review if you like us, and that does help our. What's it help? I don't want to say our credibility. We'd like to think we have credibility. But, it does help to alleviate anybody that might have put on a spoken person might have put on there. So two things. Please visit our website, and if you get a second, please send happy birthday greetings to Donna. Everyone knows how hard Donna works, and she's upstairs looking after us tonight. And I'm sure she'd appreciate the text or the email.
Absolutely. Couldn't do it without her.
No, we couldn't. Anything else, Matt?
Next webinar will be the first Tuesday of February, which I believe is February 3rd.
Okay.
Yeah.
Day after Groundhog Day.
Yeah.
I may be, Judy and I may be out of the country, and if so, I'm sure you'll do a wonderful job.
I'll do my best.
And I'll be best to catch it no matter where I am. So thanks, folks, for putting in an hour on a rainy night. I didn't see that coming. I thought it might be a snowy night, but glad that you were here, and we certainly appreciate your support. Once again, thank you for being a client, and it's a privilege to serve you.
Thank you. Have a great night, everybody.
Good night, folks.